What's going on, guys? It's crazy. My son is 5 years old. He's gonna be 6 this year, and he's going through some crazy phases in his life. But at least every phase that he's going through, he has more independence. Like he's starting to give himself a bath. He still sleeps with mommy, but he's giving himself a bath already. So, it's crazy watching him go through these phases. Home ownership is the same way. I've gone through different YouTube videos. I've made 10 steps of home ownership. But I learned everything moves in phases. What's the difference between phases and steps? Sometimes you're in that phase for a while. And tonight, guys, we're going to explain the 5 phases of home ownership. Tonight, we're going to go through phase 1. All right, but definitely, guys, welcome to our live stream. The goal of our live stream is to educate, empower, and to connect you with a mortgage. If it's your first time tuning in, do me a favor. Hit the subscribe and notification button so you're notified every time we go live or post new content. Hopefully you're having a great night. What's up, Manny? How you doing? Rudy, what's going on? Oh, the comments are back. All right, guys. Hopefully you're having a great night. It's crazy. I've learned a lot through watching consumers and talking to consumers. So from 8 to 10 p.m., I've been dealing with a lot of the phone calls myself. I know before 8, my team jumps in. And on the weekends, I've been jumping on calls. So as I've been jumping on calls, I've noticed we need to revert back and do the coaching and training a different way on what's a mortgage. So I broke down these phases, okay? Let's get into it, guys. So the 5 phases of home ownership, all right? Here, pull up some slides right here. So when you buy a home, before you even get there, you have to understand there are 5 phases to home ownership. And once you understand the 5 phases and we break down the 5 phases, it'll push you closer and make it easier for you to enter into home ownership. All right. So these are the 5 phases. There is the qualifying phase. There is the realtor phase. There is the house hunting phase. There is the escrow phase and the funding phase. Okay. So if you're already looking on a home search, if you're out there driving around trying to wait for open house signs to pop up or looking for an open house sign, stop right now. We're going to go into the qualifying phase first, which is the first phase. So once you get through the qualifying phase, then there's a second phase, finding the real estate agent who's going to help you, represent you, and get you into the home of your dreams. And then there's a third phase. It's the most exciting phase, but can be crazy if you don't do it right, is the house hunting phase, going over finding the house, the purchase contract. And then there's the fourth phase, which is the escrow phase. So now that you found a house, now it's time to process the paperwork to guarantee the loan to get the house. And then there's the fifth phase, which is you draw docs, the funding phase, right? Now you get your keys, you're excited, you get your home. So these are the 5 phases of home ownership. So definitely check out my Facebook, my YouTube, and my Instagram. Will be releasing these phases every couple weeks. So definitely check it out. That's how we're going to end 2020, understanding the phases, right? So when you enter into 2021, you know how to make the best decision for you and your family, okay? So definitely, guys, understand these phases. But tonight, we're going to talk about phase number 1, right? The qualifying phase. So in the qualifying phase, we're going to go over the different types of financial institutions that will loan you the money. The second thing we're going to go over, interviewing the lender, okay? We're going to go over how to interview the lender, talk to the lender, ask all the crazy questions. The third thing we're going to go over is the documents you need to provide for the lender to approve you for your mortgage. And then we're going to go over the different programs they can approve you for and what programs best fits your needs. Maybe you should get approved for multiple programs. And then after that, we're going to go over the loan approvals. There's 3 types of loan approvals. I'm going to break it down for you. And last but not least, we're going to show you how to shop for your mortgage, right? So that's why this is a qualifying phase. So if you're in some of the other phases, but you haven't gone through phase 1, you need to stop right now and understand the qualifying phase. All right, guys? Hopefully tonight, we're going to empower you. Next week, I have an interview. That's the reason why this one's going to be a little bit longer. So put your seatbelt on, right? Have your water, your drinks next to you. This will be on video, so you can watch it again. But definitely, guys, this night will be a little longer because I'm doing the teaching for tonight that will last 2 weeks. because next Monday we're going to be interviewing a real estate agent. Okay, so let's get into the types of lenders. So there's 4 types of mortgage lenders. There's a brick and mortar, there's a mortgage bank, there's a corresponding lender, and there's a mortgage broker. You've heard me go over this before, and I'm breaking it down again because we're putting it in the phase of qualifying. All right, so these are the 4 lenders. Pretty much when you're out there shopping and you're getting a residential mortgage, which means on a single family home, a PUD or a condo, duplex, triplex, or fourplex. Once you go past a fourplex, it's a commercial loan. Okay, so when you're shopping, there's these four institutions. It was me. That's why I would get approved ahead of time. So you want to talk to all 4 institutions if that's what makes you feel more comfortable, right? We're going to break down what each institution does so you can make the best decision for you and your familia. Okay, so here we go, right? Well, let's talk this, right? The brick and mortar banks. If you have good credit, a big down payment, upgrade, or you're upgrading, downsizing, or have tons of equity, and you have money, they will fight for your business, right? The brick and mortar banks, they want to deal with the movers and shakers, and they'll move and shake for you. All right. So when I say brick and mortar bank, I'm talking about your credit union, U.S. Bank, Bank of America, Citibank. Anytime you can go and make a deposit. If you can get a money market account, you can open a savings account, you can open a car loan, you can get a car loan, right? That's a brick and mortar bank. So if you plan on going to brick and mortar bank, you must have good credit, you must have good income, and you must have a lot of money. Yes, they can't turn you away if you don't, but they're very conservative when it comes to the underwriting process and qualifying you. Why is that a big deal? You don't want a bank to be too flexible. Remember, they are taking your depository money, the money that you deposit in your bank account, and they're loaning that out to make interest. You want them to take minimal risk. So they do take minimal risk, right? So they will reward you with good credit. They will reward you with a big down payment. They will reward you if you have tons of money in the bank. I'm sure you've heard stories before. Yes, it's true. If you have a couple $100,000, a couple $1,000,000, they will bend and fold and give you rates that don't exist. Because if you have that type of money, you're not a big risk. And if you are watching this video and there has been recently a mortgage crisis, financial crisis, or some type of pandemic, this is when the banks, the brick and mortar banks, get more conservative, right? They'll do away with 5% down, 10% down. Some banks will want 20% down. They're not willing to take that risk, right? If there's a pandemic, people lost their jobs, or there's shortage of money, of people, of whatever it is, they're gonna pull back. So if you're a first-time home buyer coming in with 3% down, 5% down, 3.5% down, or going VA, they will approve you, but they might be too conservative where they have lower DTIs and higher rates, which means you'll qualify for less homes. Okay, so when you go brick and mortar, I think they're fantastic for 10% down, 20% down, 25, 30% down. But if you're an entry-level buyer, I do not recommend brick and mortar because you will have a hard time getting your loan approved. And if it does, it might not be at the dollar amount you want or the rate that you're going to be happy with during the time whenever you're buying, right? So definitely brick and mortar, it's out there, but be very, very careful. Okay, next one, right? The mortgage banks. If you're a first-time buyer, you need down payment assistance. If you're looking for certainty, mortgage banks are the places to go. Okay, so when I'm saying mortgage bank, I'm saying Loan Depot, Quicken, Fairway, Better.com, New American Funding. So there's a bunch of these mortgage banks. The difference between a mortgage bank and a brick and mortar bank, you don't really go anywhere to do any depository. They're in the business of mortgage. So they're going to be a lot more aggressive than the brick and mortar banks, right? They're going to deal with the first-time home buyer. They're going to deal with down payment assistance, right? They've done their math and their homework and the risk they're willing to take because mortgage is their full-time business. Mortgage banks have their own money. They use their own resources to process, underwrite, draw docs, and fund. Okay, so the reason why I like mortgage banks for first-time home buyers because they're flexible in their understanding. If you're gonna go 10, 20, 30% down and you're gonna go with a jumbo loan or a non-qualified mortgage, mortgage banks might not be for you. Okay, so if you're a first-time home buyer or you're putting 5% down, 10% down, and you're buying in the 400, 500, 600, 700s, they're there for you. When we start getting in the millions, right, or in the above $800,000 loan amount, they might not be the best choice. Okay. One thing I do like about mortgage banks, they have more programs, more options. So if what you're looking for is outside the box, like a renovation loan, USDA loan, right? If you're looking for down payment assistance, that's the place to go. I wouldn't recommend you go to the brick and mortars or some of the other ones, right? They give you more certainty because they're using their own money to fund everything. All right. So that's the mortgage bank. Next one, right? Corresponding lenders, they are similar to mortgage bank, but with less power, right? Because they're not as highly funded. They don't specialize in condo spot approvals, renovation loans, down payment assistance, USDA, escrow holdback. That's when they're holding the money to fix the property. They are limited to loan products, okay? But they do the FHA, conventional, and VA, and they do close fast, all right? So when you're going with a corresponding lender, right? Hopefully you're a VA, FHA, or conventional loan, right? So I used to work at a corresponding lender. I'm there for a long time. I did a lot of business, right? I was kind of like the godfather at my company. We did FHA, VA, and conventional to the T. But when people ask for down payment assistance, they ask for renovation loans, or they ask for these certain government products, we just weren't fully funded to handle that, okay? They're good. They have their own money. They fund their own loans off their own warehouse line, just like mortgage banks. They just don't have every product under the sun. But if your product is vanilla, they are good companies. I do like them, right? But when you start getting into some crazy products, they might not be the place for you. All right. So next one, right, is going to be mortgage brokers. Very versatile when it comes to loan programs and rates. They use other wholesale lenders' resources to push their loan, but they're brokering it to these banks, right? They shop different wholesale lenders to see who can best do your loan at the greatest profit to them. If you have a non-qualified mortgage, you have an FHA or VA under 620, high debt to income ratio over 50% DTI, this is the place for you. All right. So if you have a outside the box scenario, ITIN numbers. Actually, ITIN numbers, there's a company I like called Self Help in Pomona, California. They specialize in ITIN numbers. Okay. So if you're doing an ITIN, they're great. If you don't go to them, mortgage brokers will have other options for you. If you're self-employed and you didn't file your taxes, right, you're going to have to put 20% down. Mortgage brokers, they know all the banks under the sun to submit your non-QM loan. Okay. So they're great when it comes to conventional FHA and VA. They're seasonal. There's certain season when rates are smoking, right? And they blow everyone out of the water. And there's certain times when it doesn't, right? But of course, mortgage banks, corresponding banks, they'll always compete with mortgage brokers. The big banks, they're not like the brick and mortar banks. They're not in the business of loans. They're in the business of being a bank, right? So they're not going to fight. But between mortgage brokers, corresponding lenders, and mortgage bankers, they're all going to fight for rate for you, okay? So definitely, those are the 4 types of mortgage lenders out there who will compete for your business, right? Hopefully you understand now. So when you're shopping for your loan, you need to find out, hey, what type of lender are they? If they tell you they're a mortgage bank, but they don't service their own loan, they're not a mortgage bank, okay? They're just a corresponding lender. They don't sell to Fannie Mae or Freddie Mac or service their loan. I would move them from mortgage banker actually to corresponding lender, right? Because they're not doing all the bells and whistles, okay? So now that we've identified the type of lender to get qualified at to finish phase 1, the next step is asking the questions, okay? Interviewing your loan officer before you decide to pick them. These are the 4 questions I want to make sure you ask, okay? What is your NMLS license, right? Your national multi-state licensing system, right? What is your license number? Okay. What is your specialty? And I'll go into that second, right? What are your lender fees? And who issues your loan approval? Okay. So hopefully you understand these are the 4 main questions that I would ask, okay? Because everyone else will say, oh, I always answer my call. We have the lowest rate, blah, 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 blah. This is what you want to know, okay? Because remember, you can still shop for your loan, so that's not a question you want to know. You want to ask these questions. Are they licensed? If they're at a mortgage bank, trust me, they will be licensed. The bank will get them licensed, right? At the brick and mortar banks. At the mortgage bank, same thing. They will make sure you're licensed. The mortgage banks and the brick and mortars, definitely the loan officer will be licensed. Why is that important? God forbid, if anything goes sideways, there's someone responsible. You think about it, you go out to somebody, they offer you a loan, but they're not the licensed person. They're not responsible. The company will be, but people who aren't licensed, not all, but a good portion of them, are very negligent. There's a reason why they don't have their license or they can't get their license. So make sure they're licensed. When you're talking about corresponding lenders and you're talking about mortgage brokers, a lot of times there's a lot of salespeople who work for these guys where they're not licensed. You should be like, by law, you have to be licensed, but corresponding lenders and mortgage brokers are not really on top of making sure everybody's licensed. So when you're dealing with a corresponding lender or a mortgage broker, ask for their NMLS license and look it up and make sure it's active, right? If they're not active, then your loan's not going to be active. So make sure they're active. That's the first question. The second question, what is your specialty? If they say they specialize in everything, pump your brakes. Typically, if someone is a specialist in jumbo loans and A-paper loans, right? Jumbo loans, they won't be doing FHA, they won't be doing VA, they won't be doing down payment assistance, okay? And those who specialize in VA and FHA, when it comes to high balance or jumbo, it might not be their cup of tea because they won't understand the complicated tax returns, okay? So definitely make sure you talk to the lender. What do you specialize in? For example, if you came to me, I'm telling you right now, if it's a jumbo loan, I would tell you to send it somewhere else, and the rates are better somewhere else as well. If someone came to me with a USDA loan, I don't do a USDA loan. US Loan Depot, where I work, does USDA loans, but I would tell you go talk to this loan officer because I don't specialize in it. Same thing, right? If you talk to somebody, ask them the question, what do you specialize in? A lot of people who, like I have a colleague, she is insane when it comes to new build conventional purchases, but she had a problem putting together a VA purchase. She's been a loan officer for over 10 years. So definitely find out their specialty. They'll all say that, oh, first-time home buyers are their specialty. I'll tell you right now, first-time home buyers are my specialty, right? But if you're going to go USDA, I'm not going to mess with you. If you're going to go, you're going to try to layer on 10 different down payment assistance, I'm not your guy. I'm not your loan officer, right? So make sure you find out their specialty. Third question, you want to know, what are your lender fees? I used to work for this guy. I'm not going to say his name, but he kind of a dirtbag type of guy. He was my mentor in the beginning. The reason why we don't work together anymore is the way he pitched the fees. I didn't like it. When people would ask him what the lender fees are, he would tell them it all depends on the house you pick, when you pick it, or the program. And that's wrong, right? Every lender knows their fees. It's between $1,000 to $2,000. $2,000 being on the high end. Well, I've heard some people say there's a no-cost fee loan, right? With these no-cost loans, you're taking a higher rate to cover that lender fee of $1,000 to $2,000. But there will be a lender fee. Make sure you're dealing with someone. It's a test of character. They're straight up. What are your lender fees, right? I tell people $1,500 and you got to pay for your own appraisal, okay? I would tell people that straight up. Definitely make sure you're working with a lender that's confident about their worth and confident about their fees and tell it to you, right? You want honesty, right? I'm sure if they bought something, they want honesty. So make sure they stay honest with you. Fourth question to ask, okay? Who issues the approval? Keep it 100. People talk to me, I'm like, I don't issue your approval. The loan officer that's going to talk to you is going to issue your approval, or my underwriter is going to issue your approval, right? Make sure you're dealing with the person who issues the approval. Why is that? You don't want to be shopping out there with a boo-boo approval and wasting your gas, wasting the realtor's gas, wasting your time, getting into escrow, giving your 30-day notice at your current landlord and realize it was a busted loan. Make sure you find out, hey, who's issuing this approval? Are you validating my credit, my income, my assets, right? Or are you validating it, or is your under validated, which we'll go over in a second. But find out who validates and sends and gives out the approval. That's who you want to be working with, and you want to keep in contact with that person, because when you get new pay stub, new bank statement, you want to make sure that you're dealing with the right person. Okay. So now we know the type of lender who's going to issue these approval. We know how to interview the loan officer, right? To make sure we're dealing with someone who knows what they're doing. Next thing is the documents you need to bring to get your approval, right? So there's 4 things they validate. They're going to validate credit, they're going to validate assets, and then they're going to validate the home once you find the property. But the one key component that needs to be validated is your income, the ability to pay back the loan. There's fixed income, rental income, self-employed, and wage earner. Okay, so fixed income, right? Fixed income is a beast of its own. We'll go over that in a second. So there's fixed income. There is Social Security income. There is child support. There is alimony. There's permanent disability, and there's court ordered. Okay, so if you have fixed income, you fall under one of these categories. The name of the game is proof that you're getting it. That's ordered by somebody. Proof that that the dollar amount is actually hitting your bank account, and proof you're going to receive it for 3 more years. So if you're on Social Security, they're going to ask for a reward letter, right? Sometimes they'll ask for a bank statement to prove that that dollar amount from the reward letter matches your deposit. Okay. If you're doing child support, they're going to ask for the child support paperwork. Whatever it says, you want to make sure you're receiving it. Same thing, alimony. You got the divorce decree, permanent disability. You got letters from doctors, insurance, right? If it's anything that's court ordered, they're going to ask for these couple things, right? Also, if you went through a lawsuit, you're receiving money. That's why I put on a court order. But besides Social Security, child support, alimony, right, could be permanent disability too. It's all court ordered. So when you're looking at the court order, you want to see the dollar amount. For example, if they say you receive $4,000 a month, but they look at your bank statements, you're only showing $3,000. You're only going to use the $3,000. You can't use the 4, even though it's court ordered. That's the proof that you're receiving that money. Okay. Also, they want to make sure that you're going to receive it moving forward as well. Oh, one last thing. So if the court order says $4,000, but you're receiving $7,000, they'll only let you use the $4,000. Right? They're going to go worst case scenario, because court order is only 4. Even though you're getting 7, you have 10 years, you're receiving 7,000. It doesn't matter. Okay. And now the proof you're going to receive for 3 more years. So with child support, if your child is 15, unless there's a letter saying that their child's going to receive it longer than 18 because they're going to college, it needs to be court ordered, or you can't use the child support as income. Okay. So if it's Social Security, child support, alimony, permanent disability, or any court order, you want proof of life, proof of deposit, and proof that you're getting it in the next 3 years if you want to use fixed income. Okay. So next income, rental income, right? Before we get into rental income, understand there's new landlords and seasonal landlord. If you're new landlord, you need the lease agreement, copy of first month's deposit or rent, right? If you're a seasoned landlord, right, you have tax returns to prove it. If you're buying property in the future, you're gonna do the same thing, the lease agreement, copy of the 1 month of the deposits, right? So this is the thing when it comes to landlords. If you're vacating a property to upgrade to another property, the property you're vacating, right, you're going to rent out. So if you haven't owned a property for 2 years, so you're technically a new landlord, right, you get to use 75% of the gross rent income up to the mortgage payment. Here's an example. If you receive $4,000 a month for rent, you can only use $3,000 a month. But the mortgage payment is only $2,500. You can only use the $2,500. You're short $500. But if you've been a landlord for over 2 years and you have the tax returns to prove that you are a landlord, you can use the difference of the money. For example, on $4,000, if you're receiving 3 and the mortgage payment is 25, you can use that $500 to help qualify your income. Okay. Also, if you are an experienced landlord, whatever's on your tax returns is proof of your current income as a landlord. All right. So hopefully that helps you out. Or what happens if you've been a landlord for over a year? If you've been a landlord for over a year, the property that you're claiming the rent on, you can use the rental income, right, to help you wash your mortgage payment, qualify that current property you have. But on the new property you buy, this is only 1 year, you can only use up to 75% or the mortgage payment, whatever's less. All right. Hopefully that helps you out there on understanding rental income. All right. Next one, self-employed. I've been getting this question almost every day. I'm assuming everyone's going to file their tax returns at the beginning of the year and try to buy a home. Okay. understand the paperwork, and then I'm going to explain to you some methods here, okay? So if you're an independent contractor, you're 1099, you're going to receive a Schedule C, okay? You want to bring your Schedule C in, okay? If you are an S Corp, C Corp, LLC, you're going to bring in your 1120Ss and your K1, all right? So let me explain something. If you're buying a house, the one thing that what pretty much irks me the most are people when they're not reasonable. You're self-employed. You're either going to pay Uncle Sam or you're going to pay high interest. Your pick. If you pay Uncle Sam, that means you file your tax returns, right? You're going to get the lower rate, the lower down payment, net, you're coming out of pocket a lot less, okay? If you don't file your tax returns or you write off everything, you're going to have to put 20% down and take a rate about 1 point to 2 points higher than someone who's a wage earner. Don't forget, you didn't pay Uncle Sam, now you got to pay the bank. You pay the bank, right? If you do pay Uncle Sam, you get a lower rate. If you don't pay Uncle Sam, you get a higher rate, okay? So that's just how it works, all right? So if you are independent contractor and you wrote off everything, there's another option. If you have good credit and you go 5% down and you've been self-employed for 5 years or your business has been around for 5 years, they'll go 1 year self-employed. That means the recent year that you filed, then you can buy your house. So you got to pay Uncle Sam 1 year, not 2 years, 3 years, or 4 years, but now you can buy 5% down conventional. So make sure you have good credit, but you're going to bring in the same documents. Remember, it's your net income plus your depletion, depreciation, and your business miles, okay? So make sure you pay attention to those things when you're looking at your tax returns. All right, next one, okay? Wage earner. If you're a wage earner, you're going to bring 2 years of your W-2 and your recent pay stubs, all right? So that's what you need to bring in as a wage earner, okay? So when you're a wage earner, remember this. If you started the job the year that you're buying, right, just collect the last pay stub from your last job and then the first pay stub from your new job and then the last pay stub from your new job, right? So you want to see where your pay stub ended at your old job. If you transition the year that you're buying, and then the first one and then the recent one, the reason why it's easy to calculate what your income was, right? For example, if you change jobs in March, you want to get March's pay stub, and then you want to get the other March pay stub when you transition, and then your year-to-date pay stub. Now, the reason why it's important, right? Because they want to see your average income. So when you are buying, make sure you have your 2 years W-2, your recent 30 days pay stub. Unless you're changing the year that you're buying, you want the last pay stub from your employer, right? From the old one, and then the new one, and then the recent one, okay? So you want these pay stubs so the story is painted very well for the lender so you can maximize your approval, all right? If you're buying a house and there was a pandemic or there was some crisis, yes, the CARES Act said they're not going to count the crisis, but they are counting it. So if you start back up at work and you're working under 40 hours a week, they're not going to average it. They're just going to average your last 30 days. If you're working 40 hours a week again, then they'll give you your full 40. But if you come back 2-3 days a week, right, they're only going to average it out that amount for that last 30 days, not from when you got laid off or before you got laid off or the last 2 years. So remember that when you're qualifying as a wage earner. If you're self-employed, going back to self-employed, they're going to want last 30 days. They want to see your deposits to make sure your business is still intact and you're making money, okay? So check out this form. This form is in our Ultimate Mortgage Guide. Go to whatsamortgage.com and you can download our Ultimate Mortgage Guide, and we have this checklist for you here so you have the information you need to bring in to get qualified, right? Most lenders these days, you can upload it through their portal, you can scan it in, you can bring it in, you can fax it in, but here's what you need, right? You need your proof of ID, right? Remember the 4 keys to unlock a mortgage. If you follow me, you understand identity, credit, income, DTI, right? So you're going to bring in your proof of ID, social security card, work visa, right? You're going to bring in your credit report if you're shopping it with another lender and you already had your credit ran. If you haven't, that lender will run your credit, okay? Mortgage statement, tax insurance for all the other properties you own, right? To your tax returns. You want recent pay stubs, assets, recent assets, so they can qualify you appropriately so you can go ahead and shop, right? Qualify and shop for your home, okay? So we talked about the different types of lending institutions already, okay? We talked about the qualifying question. We talked about the documents you need to bring to get qualified. The next thing is your mortgage options, right? We want to know about your loan options. So here are the most common loan options out there, right? If you're looking to purchase a home and you're getting qualified, These are the probably 99% of the options you're going to get. There are other programs, but 99% of the options, I put it up here for you, program options, right? There is non-QM. Like I said, if you're self-employed or you can't prove income, you're going to go 20% down. You're going to go stated, 24-month bank statement, asset depletion, right? This is where the rate's going to be higher, but you're not proving any income, okay? Jumbo loans, check out your county loan limits. If the loan limits is above the county loan limits, you're going to get a jumbo loan. Right now, it'll probably be 10% down, right? Also, they have lower DTIs. They're loaning you above the base or the conforming loan amount, right? So they're taking a bigger risk, so they're gonna have lower DTIs, right? Also, when you go jumbo, you might want to go for sure to the big banks, all right? Check out the big banks. And then there's USDA, which is an FHA, right? In the rural area, there's ARMs, right? Adjustable rate mortgages. Typically, if you're self-employed or you're gonna you're gonna live somewhere for a short period of time, ARMs are great. Rates are low, right? I don't recommend it if you're on fixed income or you don't know how long you plan on staying in the property, right? ARMs are good for people who know, right? Also, then there's VA loans. That's probably one of the most common ones. VA loans, FHA loans, or conventional loans are the three programs majority of you guys are gonna fit under. And also, you go conventional. There's lender paid MI, which means you take a higher rate to cover your closing costs. Single premium MI means you pay the MI all at one time, or monthly MI where you pay it monthly till you have enough equity or you pay down your house to a certain dollar amount and your MI goes away. Last but not least, down payment assistance. Once you bring in all your documents, you pick your lender, right? And you know where you're going. These are your options. You might want to check this page, loan officer. Which option do you specialize in, or which option do you do? Most lenders will say, I do them all. Doesn't mean all of them, they're going to grade them the same. Some lenders who are really good at conventional are really good at conventional. It all depends on the LO and the company. So make sure you want to pick the right company, ask the right LO, so you can do what's best for you and your family. All right? So, next one, right? So now we know the programs. There's 3 types of loan approvals. Okay? There's DU. You'll probably hear that all the time. Let me send me the DU, send me the DU, send me the DU, right? There's a pre-approval or pre-qualified letter, and then there's the underwritten and conditional approval. Let's break that down right there, okay? So, the DU. When they run DU, it's called desktop underwriting. Sometimes they use something called LP, loan prospect, okay? That just scrapes your credit. The problem with DU, they don't scrape monthly payments on collections. They don't scrape monthly payments on student loans. So if you have student loans or you have collections, make sure you manually put those into your loan application. But if you have good credit, DU is great, right? The DU scrapes the credit, but they also scrape the loan application the lender puts in. So the loan officer is optimistic. He might give you an income that might not be what the underwriter wants to see, but you'll still have your DU. So if you're a selling agent, trust me, you don't want just the DU, right? You want the conditional approval. So if you're out there, you see people, oh, here's a DU. It's an approval that just cleaning up the credit, right? It's scraping the credit. There's a high chance you're going to get approved, but I wouldn't trust the DU, especially in a seller's market right now, right? The last thing you want is to fall out of escrow. Second type of approval, they call it pre-approved letter or pre-qualified letter. That's when a loan officer, after they run the credit and they check the DU, they go on their desktop, they type in an approval for you, right? But remember, the loan officer doesn't give out loans. The underwriter does. So be careful. I've seen people, especially guys who are unlicensed in corresponding lenders or mortgage brokers, they just have a template on their desktop and they can just spit out an approval like that, right? But think about, you're shopping around and the approval's not real. No one's validated income, asset, or credit, right? You're walking around and all of a sudden your loan's not approved. That happens pretty often, actually. So for me, I would actually trust the DU a little bit more. I would see the DU with the pre-approved, pre-qualified to have a little bit more faith, but you want to go pound for pound for this underwritten approval, conditional approval, okay? The conditional approval and underwritten approval is done by the underwriter who actually issues the approval. That's why when we go ask that question on who issues your approval, right, to your loan officer, say that it's an underwritten approval by an underwriter. That's gold, okay? That means if the underwriter issued the approval, they validated income. They validated credit. They validated asset. Now all you need to do is find a home so they can validate the property. So these underwritten approvals are going to be kind of lanky, right? They're kind of thin because you haven't found a property yet, so they can't look at the title report and all that and the appraisal. But I want to get my credit, my income, and my asset cleared by my underwriter, right? So when they give you the conditional approval, you start working on the condition. If it was me, I want to clear those conditions now. When my house goes into escrow, I'm closing like this. I'm not dealing with what ifs. Everything's been validated, right? And the underwriter actually issues the final approval, which means you can go to Docs and Fund. So why wouldn't you want them actually giving you your approval? All right? So now, the qualifying process, right? We learned the 4 types of lenders out there, right? We learned the 4 questions to ask, okay? We learned the documents you need to bring depending on your income, right? We learned the program options. We learned the different approvals. Now that we're near the tail end of the qualifying process, the last step before phase 2, the realtor is shopping your mortgage, all right? So these are the 4 steps of shopping your mortgage. Secret number we're doing is all 4 today, right? Run your credit with the lender. Credit Karma uses Vantage Score 3 to raise your credit, okay? Your credit card companies use Vantage Score 8, right? Mortgage lenders use FICO Score 2, 4, and 5 from Experian, Equifax, and TransUnion, okay? So make sure one lender runs your credit. It's good for 90 to 120 days, okay? So make sure they run your credit, generate your profile. Then you can shop your loan with the loan estimate, right? Shop around for a loan estimate and match up the loan estimate to the loan officer you're comfortable with, okay? So once you run that credit, you need to know the middle credit score. Once you know the middle credit score, that's what you're going to use to shop, all right? The next step, you're going to generate a profile page. What's a profile page? Here we go, okay? Here's a profile page, right? So a profile page is the type of property, the goal of the loan, right? Pretty much a purchase, the loan type, the occupancy, the date the credit report was done, right? The LTV or loan amount. So it's going to be either 3% down, 3.5% down, 5% down. So it'll be either a 96.5% LTV, 95% LTV, or 97. For every 5%, it's going to be like, let's say 90%, 85, right? So that's the LTV, the interest rate that you're getting from your first lender that ran your credit, your middle score, your purchase price and appraised value, and the county you're looking to purchase in, okay? So once you have this profile, right, now it's time to shop, right? You ran your credit, you generate your profile. You want to call all the lenders on the same day. Why is that? Rates change daily. They change by the minute almost, but it's safe to say shop daily. So whatever you shop with one lender that day, shop your other 2 lenders. Why? You want the rates to be accurate. One lender can be good one day. They all can be the same, but if you shop the one the other day and rates drop or got better, then you're not giving everyone a fair chance. And on top of that, you probably don't know which one's the best deal, okay? So once you figure out, you get everyone to send you a loan estimate. They don't give it to you, just ask them for the fee sheet. If they don't give that to you, you ask them for the rate, the lender credit, and ask them for the lender fees. Once you have that together, right? Step 4, you want to match up who's got the best deal. And if the lender that actually you like doesn't have the best deal, show them, hey, this is the best deal on the block. If you match this, I'm going with you. But if you can't, I'm out, right? It's a business, okay? So these are the 4 steps to shop for your mortgage, all right? And I'm going to show you guys this one more time, the profile page, all right? So you can get this profile page at whatsamortgage.com, right? You can get this profile at whatsamortgage.com. You can get all these other information at whatsamortgage.com and go to our Ultimate Mortgage Guide and download it, right? You'll see this profile page. You'll see the documents you need to bring in, right? Here we go, right? The Ultimate Mortgage Guide, free to download at whatsamortgage.com. But if you have questions regarding phase 1 of home ownership, right, the qualifying phase, you can always call us 714-909-1533. Call us or text us or message us, right? Before we get in the comments, I want to thank everybody who watched, liked, and shared. And we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you guys so much. Again, thank you so much for watching our show. If you have any challenges or concerns regarding what's a mortgage, call me 714 332 2526.